Hi, this is John Persinos, Editorial Director of Investing Daily, with a video update for Tuesday, September 8. The Labor Day holiday is now behind us, marking the unofficial end of summer. What can we expect in the coming months? Last week finished on a down note. The major equity benchmarks closed lower last week as pessimism about the pandemic and economy crept into the markets. Will the downward momentum continue? Let's look for clues. Doubts about the resilience of the supposed recovery weighed on the markets last week. Unemployment hovers at an extreme high, and many temporary layoffs, they are becoming permanent. Investors also are growing pessimistic about the coronavirus pandemic as infections and deaths flare in regions of the country that have been practicing lax social distancing. College campuses are emerging as new hotspots. What's more, talk of an imminent vaccine is starting to ring hollow as Wall Street belatedly realizes that it's scientifically impossible for a treatment to arrive before the end of the year. Current efforts in Washington, D.C. to fast-track a treatment before the November elections, they smack of a political stunt, and investors are starting to figure that out. The confluence of these headwinds produced a down week for the major benchmarks. Take a look at my first chart. Even with last week's decline, the S&P 500 is up more than 50% from its March 23 low, with returns to new highs in recent weeks. But volatility returned to the stock market last week with declines on Thursday and Friday of 3% and 1% respectively. Previous to last week's decline, the S&P 500 had gained ground for 4 consecutive weeks to reach a record high. The red-hot Nasdaq took a breather that could either indicate a healthy pause or the beginning of a trend reversal. I suspect it's the latter. What's the state of third quarter earnings projections for the S&P 500? Not so good. For Q3 2020, the estimated earnings decline for the S&P 500 is minus 22.4%. But optimism is creeping in. Take a look at my second chart. During the first 2 months of Q3, analysts boosted EPS projections for companies in the S&P 500 for the quarter. The Q3 bottom-up EPS estimate increased by 2.6% during this period. Bottom-up is an aggregation of the median EPS estimates for Q3 for all the companies in the index. But keep in mind, the U.S. economy posted its largest quarterly decline in GDP in the second quarter, contracting by an annualized rate of 32%, 4 times larger than the worst quarter during the 2007-2009 Great Recession. But valuations remain historically high, as reflected by the cyclically adjusted price-to-earnings ratio, aka the CAPE ratio, developed by Professor Robert Shiller of Yale University. Take a look at my third chart. The CAPE ratio is defined as price divided by the average of 10 years of earnings, the moving average, adjusted for inflation. The ratio currently stands at 31.47, which is 99.1% higher than the historical median of 15.8. As this chart makes clear, stocks are hovering in an extreme valuation bubble. Volatility is likely to accelerate in the coming months as pandemic and political uncertainties roil the markets. Under these conditions, you need to maintain a diversified portfolio and rotate towards stocks that are tapped into trends with long-term momentum. For a hidden mega-trend stock that's poised to soar, follow the link at the bottom of my article that accompanies this video. Well, that's it for now. I always welcome your feedback. I'm easy to reach. You can reach me at mailbag@investingdaily.com. In the meantime, here's to your health and your wealth.